Hi there, welcome back to another edition of Terra Firma Education, and this is Robert Wolf with Terra Firma Business and Financial Consultants. As an asset coach and a tax strategist, I'm always asked about the 1040 personal tax returns. In part of our educational process, if you haven't already been working with us and you're watching these videos to kind of get a feel for how we think and how our process works, I decided to put together this little workshop or this little educational material on the 1040, on the flow of money on the 1040, and specifically some of the changes that occurred with the Tax Reform Act of 2018, and some of the things that you're going to see that new tax season of 2018 for your filing. And if you're watching this and you're a business owner, there's significant opportunity for you. Actually, the tax law is improved for you as a business owner. If you're not a business owner and you're a high earner employee, and what I mean by a high earning employee, I mean somebody who's making $150,000 a year. It could be as a single or married filing joint. You have a house or some other types of assets, and you can watch one of our other videos to see what the different types of assets are. Also watch our video on the 3 stages of an asset and the rules of assets. But those are really the criteria of what we're looking for. If you're a high income earning employee that meets those criteria, we actually can put together a strategy for you to actually create a business utilizing the assets you already have. And I'm not saying a business like you're going to become a plumber or electrician or you're going to create some kind of a manufacturing company, a widget. We're not talking about MLN or direct sales or anything like that. What we're talking about is utilizing your existing assets as they are right now and making them more efficient. So without further ado, that's our introduction. I hope you enjoy this. Again, we're talking about the tax returns, the 1040, the personal tax return. So it could be a little bit dry, but I'll try to make it a little more energetic and try to capture attention a little bit. So here's my picture. Here's me. Little disclaimer: this is just for informational and educational purposes only. We're not giving any advice whatsoever. Zero, zip, zilch. It is just information, just educational. We do not know you. You do not know us, other than these videos. The moment you decide that you want to engage our services, then we'll start introducing you to some of our professionals that fit in these categories. And we'll start seeing if the planning process and the decisions and the ideas of what our strategies will be and do will fit for your situation. But until then, you're watching this, we're just talking about education and information, okay? All right, so if you haven't seen our video before about the tax savings formula, we're going to go through it right here, give you an idea of what this formula is. We start pretty much every conversation, every planning situation with a new client or a prospective client with this formula. And the reason being is that it paints such a beautiful picture of how much money we're giving away to the IRS. Okay, and so let me make sure this is clear as well. We don't see the IRS as the big bad guy. All right, they're not the big bad wolf. They're not the 800-pound gorilla, though they are 800-pound gorilla. We actually see the IRS in a different light. We actually appreciate the IRS and what they have provided for us. And why do I say that? Well, it's kind of like mom and dad when you're growing up. Right, mom and dad had certain guidelines and certain rules, didn't they? Like, don't put your finger in the light socket, don't touch the stove when it's on. You know, some basic stuff, right? And it was really for your own good. And as you got older, there were more guidelines that mom and dad had. But if you followed the guidelines, once in a while, mom and dad would say, "Hey, you know what? Let's go get some ice cream. You've been awesome, and let's go get some ice cream as a reward." But at the same time, if you did not follow the guidelines and you fell outside the guidelines, there were negative consequences, right? You were either put on restriction, your phone was taken away, or whatever the case may be, and the punishment in your family was that occurred, right? So the IRS is the same way. They have guidelines. It's called the IRS tax code. Okay, and they've told us we can do certain things. The difference is just they're not going to show you or tell you how to do it, right? Versus mom and dad, they say you don't put your finger in the light socket because you'll get electrocuted, right? Or you'll burn yourself, or what they may describe what could be the negative consequence to not following the rules to you individually, not necessarily what they're going to do as a punishment. And sometimes they do. Now, the IRS also says that they're going to fine you, they can audit you, they can penalize you. There could actually be jail. So everyone gets scared and fearful, but if you're following the guidelines, there's no reason to be scared or fearful, right? It's pretty basic. So let me explain this really quick too before we go on to the tax savings formula. And if you've heard this in one of my other videos, I apologize for repeating it, but I think it's really important. To understand the IRS tax code is like a roadmap. Okay, so let's say you and I are going to go on a road trip from Los Angeles, California to Denver, Colorado. All right, we're going to go old school, right? We're going to open up a paper map, lay it on the table. We're going to have our highlighter, and we're going to highlight the freeways that we're going to go. Okay, and we embark on our journey. We're starting to drive out, and we hit a freeway that actually happens to be closed, and there's a detour. Now, the detour, the construction guys are just going to get you around the construction area, right? But there may actually be a more efficient and faster way to detour yourself. So we can open up the map and look at it, right? So we look at it and we find the right detour and then we go. Okay. Now that's not very efficient, but the case may be that's the situation, right? So nowadays we have GPS, right? We either in our car or on our cell phone. Now, if you have it on your cell phone, typically what you'll do is you're listening to radio, or because there's the two of us driving, we're probably talking. So we have the volume on the cell phone down so the lady's not interrupting our conversation, right? So what's happening? Well, typically you're driving and you have the cell phone in your right hand and you're driving with your left hand. Not so efficient, right? And not so safe either. Now, there's two of us. So what you should be doing is taking your cell phone, handing it off to the passenger, and as we're having a conversation, let's say I'm the passenger, I'll tell you, hey, go left. Hey, go right. Up in a mile here, we're going to merge onto this freeway or whatever, right? So it's much more efficient. It's safer. So the idea and the key here is that if you want to go down the roadmap and the IRS tax code, you need the right GPS. Now, you have a CPA or an enrolled agent, which you probably have a great relationship with. So we never encourage people to leave your relationship because they already understand you. You already understand them. What we are saying is have a coach, an asset coach, and a tax strategist be involved in the situation as well. Bring us along for the drive, okay? Allow your GPS, because at the end of the day, who's signing the tax form? You are. So you're responsible for it. So there really should be no reason why you should worry about the ego or the pride of your CPA or enrolled agent and what they're going to think. The bottom line is that the buck stops with you, period. So when you owe taxes, you pay it. When you get a refund, you get it. Not your CPA, not your enrolled agent. So your job is to have the right GPS. So let's go down through this formula here. Okay, so then we have our adjusted gross income, which is your total income. And we'll show you where that is on the 1040. It's AGI is what is usually talked about. And then we have what we call lifestyle income. We'll just call it living expenses, okay? And so we subtract our living expenses from our income, and that equals what we call non-lifestyle income. Why do we call it non-lifestyle income? Because it's income that you don't need for your lifestyle. You just told me what your lifestyle income was, your expenses. Okay? So this is leftover money. Some people call it discretionary. We don't like to call it discretionary because we like our money, we like our job, we like our planning to have a purpose. And the reason why we like to have our money have a purpose is because you understand the purpose of that money. You have something to strive for. You become more focused, goal-oriented. You become more driven. I have some clients where it becomes a game, where we actually do we do budget expense-based planning in our practice, not income-based planning, because expenses are what causes our income to be what it is. So I have some clients that actually have been trying to reduce their income without my help, without me saying you should do this, you should do that. They're actually, they make it a game because they see that the more non-lifestyle income that they have, the more opportunity they have the ability to take it off their tax return. Okay, legitimately within the IRS guidelines, within the roadmap, right? So basically what we're talking about is every dollar in this non-lifestyle income here is taxed at your tax bracket, right? So if you're in a 35% tax bracket and this money's left over, this is last dollar, okay? So this last dollar at 35%, that's, if you're saving that dollars, then that's basically what your rate of return is, right? You're returning your money. So what this means is you are paying taxes on income not needed for your lifestyle. So technically you are just giving money away to the IRS. So now this is why the IRS doesn't tell you how to do things, right? Because they can't, but they're going to give you the rules, right? And so I don't know, maybe you enjoy giving the IRS your money. That's perfectly fine. You feel that's your patriotic duty. There's some people who feel that they should only be giving their fair share. Why? Because the IRS gives you guidelines, right? We're not talking about lying, cheating, or deceiving. Absolutely no. We're talking about using the roadmap. The IRS gives you tons of opportunity to save money on taxes. It's just knowing where to go. So if you don't like giving money away to the IRS, let's go through this process. So what do we do? So let's, for example, I'll put some numbers into this formula here. So let's say you make $350,000, single or filing joint, doesn't matter. Your AGI is $350,000. Let's say your lifestyle income is $200,000. So that means there's $150,000 left over. Okay, as a guide, right? This is going to go up, this is going to go down. You're going to say, hey, Bob, you know what? This lifestyle income, we're not including birthdays or anniversaries. Okay, great. Let's include that. And then once we include that, let's say it was another $50,000 a year. Okay, great. Now we have $100,000 left over. Still $100,000 in a 35% tax bracket or even a 24% tax bracket. That's $24,000 savings, right? So here's what it looks like. This money is what we do is we shift it off the individual tax return to the corporate return. Now, if you're a high income earning individual that does not have a corporation, again, we've already shared with you what we're going to do. We're going to look at your situation and we're going to start strategizing how do we take and utilize your existing assets and make them more efficient to where we end up having a business. We end up having a corporate return, whatever that means, okay? There's different type of entities and we'll talk about that in another session. Okay, so now when we look at this, we have deductions. When we're talking about shifting that non-lifestyle income, we're talking about creating deductions. So let's talk about what deductions are. So as a business, we have revenue, right? You have income. So revenue is at any point in time, the IRS can say, you know what? You're running a business. You have sales of $2 million. We're going to tax you on the $2 million, right? But they don't do that, right? What they do is they say, we understand there's a cost of doing business, and those are expenses, and we're going to allow you to subtract those expenses from your revenue, and that allows you to have profit and loss. This is the profit and loss statement. All right. So once these expenses, what happens to them, they become what we call deductions. Why? Because we get to deduct those from our revenue. We subtract them, and deductions equal tax savings. Why? Because we're not paying income tax on these expenses. We get to actually write them off or deduct them. So there's two types of deductions. There's what we call non-appreciable deductions, which is office supplies, office furniture, could be your company vehicle. There's actually a lot of times, which is kind of funny, I find a lot of times CPAs or enrolled agents are encouraging clients to spend money to get a deduction. And what happens is that they're telling them and encouraging them to spend money to get a deduction. So let's say, okay, you know what, Mr. and Mrs. Client, spend $10,000 and you're going to get let's say you're in a 24% tax bracket. And we're only talking Fed, okay? Because you may be in a state that doesn't have taxes, or you may be in a state that does have income taxes, okay? So we're going to talk Fed because we're all in the same boat when it comes to Fed. Okay, so let's say you spend $10,000 and you know what, you're going to get a 24% tax deduction because you're in the 24% tax bracket. You're like, oh, that sounds great. I'm going to save $2,400. But let's rewind this. You're going to spend $10,000 to get $2,400 back. What's happening to the other $7,600? That's lost money. Does that make a whole lot of sense? Absolutely not. So if you've already seen our video on Richest Man in Babylon in the 7 rules, the 8th rule we added, of how to approach your lifestyle and your planning and how we approach assets when we start asset gathering, asset building, we look at the Richest Man in Babylon, those rules, and one of them is don't lose money. Here, with that advice, basically what you're doing is losing $7,600 to get 24 back. That makes absolutely zero sense, okay? But if I came to you and say, or your CPA came to you and said, hey, you know what? Let's look at an appreciable deduction. You're like, wait a second, what's that? Well, that basically says that hey, Mr. and Mrs. Client, if you spent $10,000, you're still going to get that tax savings, right? It's still a deduction. But that $10,000, actually, what happens is we have the opportunity for it to appreciate. It can grow in value. So next year, it could possibly be more than the $10,000 you put in today. Well, so then what you're saying is that I can get the $2,400 tax savings today, but then my $10,000, I can actually have $11,000 or $12,000 or whatever by the end of the year. And you can say, yeah, there's that possibility. So now you're not just throwing away the $7,600, right, to get $2,400. Now you're actually having the $10,000 work for you. You're getting a bonus of 2,400% discount or deduction and the opportunity for it to grow in value. So which would you prefer to have? Well, of course, everyone picks the appreciable one, right? It just makes more sense. Everybody wants their dollars to work harder for them, okay? So that's basically what happens. So how's this work? So we're going to use this visual of the income funnel. If you've already seen our video on the income funnel, then great, we're going to go through this again. If you haven't, this is the first time, fabulous. We're going to go through this. If you want to look at this again, you can go to our income funnel video to watch that. So along the top, you have your W-2 income, your 1099, your K-1, and other income. Other income could be real estate, could be trust, could be partnership, whatever the case may be. Okay, and here's a list of other income: Social Security, capital gains, dividends, IRA distributions, pensions, to just name a few. Okay, so either way, the way this works is that all your income goes down the income funnel. Okay, now where does it summarize? Well, it summarizes on your personal tax return, the 1040, what we're talking about right now. So you can have 15 businesses that are giving you 15 different K1s. It doesn't matter. They could be profit, they could be loss. You could actually have businesses that are losing money, that loss will still flow down this income funnel. And that loss will offset other positive income. Now, if you do that multiple years over and over and over, then all of a sudden the IRS starts saying, hey, wait a second, why can't your business make money? What are you doing? So that may raise a red flag here and there. But a legitimate once or twice a year, every other year, every 3, 4, or 5 years, you start a new business. Of course, there's going to be losses in a new business because it's a startup. There's certain expenses. Either way, knowing those rules, that positive or that negative, the profit or loss can go down the income funnel and summarize on your personal tax return. Okay, so here's what the 1040 looks like. Okay, now I know that there's been a redesign of the tax forms for 2018, but this I like using the older forms because it gives a good summary on one page. We're not looking at multiple schedules, 1, 2, 3, 4, and so on. We're looking at a one pager. Okay, so this used to be the one page where it's summarized. So line 7 we have our W-2 income. You can see there's some taxable interest on Schedule B, some ordinary dividends from Schedule B. This is investment income stuff, okay, from like a brokerage account. You could have taxable refund credits, estate. So let's say you got a refund the state that you live in. That would be considered income, and the next year you would have to pay taxes on that. Alimony received, capital gains, okay, your Schedule D. If you have a Schedule C, let's say you have a sole proprietor business that, let's say you sell stuff on eBay or online and it's not set up in a corporate entity of some sort, then it would be on 12. Okay, and then the most popular I see a lot of times is line 17, which is rental real estate, royalties, partnership, S corporation, trust, etc. It'll all be on the Schedule E, and that's where we have the money there. And then if you're over 62 and you choose to start taking your Social Security benefits, that's what it's saying here, because their income was over a certain amount. Part of it is taxable. Okay, and that's why you only see 15, not 17, because part of it's not taxable. Okay, so then you have it summarized down the bottom after you have your adjusted gross income. So what would be some things that would be adjusted, like health savings account, moving expenses, a SEP IRA contribution, self-employment, health, education expenses, so on and so forth. Okay, so you can deduct that here and it offsets here. So the bottom here is the adjusted gross income. This is your taxable income. Now what happens is in our formula, our AGI, which we just showed you, we take your lifestyle expenses, right, and you subtract it. And so in this case, this situation, the client had $623,000. Their lifestyle income was $300,000, so they had an extra $323,000 that they were paying taxes on. So that's like 35% on that. So 35,000 times 3 and some change, that's pretty significant, right? And then I'll show you what that dollar amount looks like. So what we do is we actually shift this dollar amount back up the income funnel as a deduction because they have a couple corporations. So we can utilize that tax planning. So how did we get there? So let's talk about the federal tax brackets. Now if you've seen our video on the tax brackets and how it breaks down, great, this is a review. If not, this is the first time, fabulous. Watch some of our other videos as well. So the way this works is that if you earn income from 0 to 19,000, you're not going to pay any taxes on it. That's why you see all these zeros. But the moment you make over 19,000, so let's say you make between 19,000 and 77,400, the first 19,000 is going to be taxed at 10%. So that's why you see 1905 right here. Now, any income between $19,050 and $77,400, all that income between those two numbers is going to be taxed at 12%. So let's say I make $77,400 on the nose. Well, that means that my first 19 is going to be taxed at 10% at $19,005, and then the remaining amount is going to be taxed at 12% at $7,002. You add these two up, and that's your total tax bracket. So it'd be $8,907. So let's say I make it between, let's say, $300,000. Okay, so the first $165,000 is going to be taxed at $28,000. Okay, $179, and then the difference between $300,000 and $165,000 will be taxed at 24%. Whatever that dollar amount is, you add it to the $28,000, and there's your taxable amount. Okay, so let's talk about this scenario in our example. Our client had $623,000. Here's where their tax broke down to. So the first $600,000, they owed $161,000, and then the remaining amount, the $23,000 at 37%, was taxed at $88. You add these two up, and there's your $170. Okay, but remember, they only needed $300,000. So with the $300,000, they only needed $60,000 in taxes. So that means there's a tax savings of $109,000. Ladies and gentlemen, how and what could you do with an extra $109,000? That's pretty significant, right? So let's talk about this opportunity cost, your current planning, what you're doing now. So this $109,000, let's look at the value. So let's say that you're 55 years old and you're going to quote unquote retire at 65. So that's a 10-year period. And let's assume that you're going to earn 5% appreciation on this 109. And let's say that just 1 year of taxes, okay, over that 10-year period is worth $178,000. Okay, so but because you're doing this every year, so you have $109,000 every year for 10 years, appreciating and compounding at 5%. Now that value is $1.3, almost $1.4 million. This is the value you're giving to the IRS. Okay, this is a good idea, a good indication of what this money means to you, what you're doing currently. But in our planning process, what we're doing is we're actually shifting that 323 away. So let's say we did that just this year. The same 10-year period, same 5%. So in 10 years, that $323,000 actually has a $500,000 value, okay? $500,000. Now, you're going to say, Bob, why would we do this 1 year when we could do it every year? You absolutely could. So let's say we did that every year over the 10 years at a 5% compound appreciation. Now it's worth $4 million. So what would you rather have? Would you rather pay the $1.4 million to the IRS, or would you like to use the roadmap they gave you, get the right GPS, and find and look at ways to actually turn that negative 1.3, 1.4 into a positive 4 million? And of this 4 million, how much of this would you want income tax free? Okay, that's essentially what we're talking about, is that the IRS code, the guidelines, the roadmap, they give us that opportunity. Okay, and in fact, it doesn't become a road trip. This actually becomes a chartered flight from Los Angeles, California to Denver, Colorado. Okay, we're just going from point A to point B as a crow's fly. Okay, now how do we do that? Well, that's where we got to look at opportunities in the tax code and look at your situation and see if we're able to do this. Okay, and that's where the planning process comes into play. So let's look at the 1040 because that's what we're talking about. This is Schedule A. Okay, so this is all the itemized deductions, and we'll break this down in a second. But the way it works is that you could write off your medical and dental expenses, okay, a certain percentage of your AGI. So if you had a lot of medical bills or dental bills, depending on what percentage of your AGI, you could deduct those. Okay, in this client situation, they had expenses, but they didn't meet the criteria or the requirements, so they had no deduction. Now, SALT stands for state and local tax, and we'll dive into this a little bit more in the next slide and what this means. Okay, so but in this case, the client had $85,000 deduction. Interest, or your mortgage interest from your home, line 10, you can actually deduct the interest from your mortgage. So in this case, that's all they had. Charitable deductions, if you're giving money to charities, you can deduct that. If you had a loss or a theft in your home, there is a certain tax form that you can fill out, that you can deduct that. In this case, the client had nothing. If you're changing jobs and there's high expenses, or you're traveling, or you're moving from one part of the country to another, and there's expenses associated with that, you can deduct that as well, a percentage of that. Now, any other expenses, okay, as well, And then there's a total itemized deduction. And now in past years, we'll talk about this as we go through, but in past years, you weren't able to, there was a certain limitation of income that you can itemize deductions. So if you see negative 9,400 here, that's because their money was over, their income was over a threshold, dollar threshold, to where a portion or a percentage of these deductions actually were added back as income. Okay, so let's look at the IRS. This is what changed. This is from their website. So the limit on overall itemized deductions suspended, what I was just talking about. So there's no limit to it now. You can deduct more of your deductions. There's no limit as there was in past years. Now, deductions for state and local taxes, sales, property, and taxes are modified. This is the SALT tax. We'll talk about that. New dollar amount on qualified residential loans. It used to be you were able to write the interest off on $1 million loan, or that was the cap. Now the cap is $750,000. Okay, so any refi or new loan in 2018 and beyond, the first $75,000 of the loan the interest can be deducted. Anything over a loan amount of $750,000 is no longer deductible. Okay. Deductions on home equity interest. What this means is that a home and equity line of credit, or HELOC, all right, if you're taking money out to pay off debt and that sort of stuff as a HELOC, you're no longer allowed to do that as a deduction. There's no interest deduction. Okay. The limit on charitable contributions, it used to be cash contributions from up to 50% of your AGI. Now it actually bumped up to 60%. Okay, so what the law wanted you to do is become more charitable. All right, so there's some areas where they capped and they reduced our opportunity, but in other areas they increased it because they want to actually have us give money to charities rather than the IRS and the government take care of those situations. The deductions for casualty and theft, same. Miscellaneous itemized deductions was suspended, what we just talked about. Okay, so let's talk about the itemized deductions. Line 40 in the old form, Schedule A is what we're going to talk about. So on Schedule A, the SALT tax, okay, state and local tax. What this meant is that the first $56,000 plus the $27,000, you add these all up and it's $85,000, right? So what happened now is that they capped it at 10 grand. So what that means is that this is 10 grand is what the cap at. What happens to the other 75,000? Now, what some people thought is that, well, it's just the income tax. So let me talk about this. If you're in a state with a high income tax, or you owe taxes to the state, what the federal government allows us to do is what that tax owed to that state, they allow us to itemize it as a deduction on our federal return. Okay, so what some people thought was it's a the SALT tax was only for that, but no, it was real estate property and personal property taxes as well. Okay, so the whole thing was capped. That's why I'm showing 51,000 up here, but in reality is what our deduction is that it's dropped now, right? It's dropped down to 10,000. Okay, so what that means is that our whole itemized, so this is only 10. If we were to add up all our other itemized, this drops down. Okay, so what that means is this taxable income actually increases. Okay, so the unfortunate thing is that now we're not at 98,000, we're at a lower amount. Okay, and so now the other part that we were talking about is mortgage interest. Now, if any of this interest was above $750,000, let's say this was a new loan in 2018, any interest on this that was over $750,000 in the loan would not be deductible. Now, this does not include rental properties. This is only home mortgage interest, is your personal home mortgage interest, okay? So that kind of gives you an idea of what the situation is. Now, on the charitables, remember, you can do up to 60%. So in some situations, I encourage my clients to be charitable. Find a charity. Could be any 501c3 charity. All right, nonprofit is considered a charity. Give. All right, give as much as you possibly can up to the 60% AGI. Why? Because you benefit personally. This is, besides your mortgage interest, this is the only real deduction that you have anymore. Okay, so we got to look at this as an opportunity. So now I appreciate this time. So that ends our education on the 1040 and the way it breaks down. We didn't go into all the other schedules, Schedule C and D and E and all that fun stuff. Those are different situations, but I just wanted to keep this very simple. I want to give you the opportunity to schedule a 30-minute strategy session. Let's look at that formula. Let's go over on the phone. Let's break down that formula. Let's look at your situation. Let's see what opportunities we have of shifting non-lifestyle income and based on your assets. As a thank you, we're going to give you a couple free gifts. We're going to give you some bonus offers here, okay? Once you schedule your 30-minute strategy session, one of the things we're going to talk about is giving you the opportunity to have a tax return analysis done for free. It's a 15-page report. On the back side of the report, it's a side-by-side of what your current tax situation, based on what your lifestyle expenses are, your budget income, what you're spending money on, and then we're going to show you where you can save the money. Okay, it's on a one-pager, side-by-side, very simple. You'll get that as a thank you gift. The other bonus offer is that if you schedule this 30-minute strategy session, we're also going to do an asset inventory report for you. What this does is that we list out all your assets. We'll go over all your assets. We'll look at them. We'll actually break them down by taxable income and tax-free income, so you have an idea. And any of the assets that are what we call tweener income. What that means is that if you go look at our 3 stages of an asset, okay, depending on how you start distributing income out of those assets depends on if it's going to be taxable or tax-free. Okay, so those are tweeners. It depends on how you're going to distribute. And then we'll also give you a money efficient plan analysis. What that means is that we'll look at your tax return analysis, we'll look at your asset inventory, and then we'll put together a money efficient plan. We'll say, okay, here's what your assets look like. Here's how you can restructure some of your assets to be more efficient, to work harder for you. And we'll give you that as well as part of the bonus offer, okay? So, but you need to go ahead and schedule a 30-minute strategy session. Let's get on the books. Let's talk. Let's strategize. And at that point, if you like what we have to offer and what we say, we'll go ahead and go through and give you these bonus offers as part of the plot process. Okay, so again, thank you so much for your time. I appreciate it, and look out for some of our other videos and training. All right, this is Robert Wolf with Terra Firma Business and Financial Consultants. Thank you so much.